Let's dive in. The idea of using gold and cryptocurrency to fix a national economy sounds exciting on paper, but the reality is far more complex. Gold has long been considered a safe haven, a hedge against inflation, and a store of value when confidence in paper currency wavers. Historically, during times of economic uncertainty, investors flock to gold because it maintains intrinsic value. In theory, investment leveraging gold as part of national economic strategy could help stabilize perceptions of value and instill confidence among investors and citizens alike. But using gold alone to prop up a modern economy is not a silver bullet. While it might provide some psychological reassurance and a degree of financial security, it cannot address structural problems such as unemployment, wage stagnation, or a ballooning national debt. Then there's cryptocurrency. Bitcoin, Ethereum, and other digital assets have captured the imagination of investors worldwide because of their decentralized nature, potential for high returns, and independence from traditional banking systems. For policymakers, investment. The appeal lies in the idea of creating alternative investment channels and modernizing financial infrastructure. Crypto can attract innovation, stimulate tech-driven growth, and potentially serve as a hedge against currency devaluation. However, cryptocurrencies are notoriously volatile. Prices can swing dramatically in hours, making them risky as a foundation for national economic stability. Relying on crypto without careful regulation or a clear strategy could inadvertently destabilize markets rather than fix them. Even if gold and crypto were integrated into economic policy, there are inherent limitations to this approach. A national economy isn't like an individual investment portfolio. It's a web of industries, jobs, consumer behavior, and global trade. You can't simply inject gold reserves or cryptocurrencies and expect unemployment to drop or inflation to reverse. Unaddressed structural problems like trade imbalances, budget deficits, and systemic inefficiencies still need concrete solutions. Policy decisions must be coordinated with fiscal, monetary, and social programs to have a meaningful impact. The idea of fixing the economy with alternative assets alone oversimplifies a situation that requires multi-layered strategies. Finally, the broader implications of adopting gold and crypto as central tools are significant. Such policies could shift investor behavior, attract speculative capital, and influence the global perception of the U.S. financial system. If executed carefully, they might create a temporary boost in confidence or offer a modernized image of financial innovation. But if executed recklessly, the economy could face heightened volatility, increased debt risk, and unintended consequences for everyday Americans. The truth is, there are no shortcuts. Real economic recovery demands a combination of strategic investment, responsible fiscal policy, and practical programs that support job creation, innovation, and long-term growth. Gold and cryptocurrency may play roles, but they are tools, not cures, for a complex, interconnected system that requires thoughtful planning and disciplined execution. Gold has been a cornerstone of financial security for centuries, valued not just for its beauty, but for its stability and scarcity throughout history. It has served as a hedge against economic uncertainty, currency devaluation, and inflation. When economies face turbulence, investors traditionally turn to gold because it preserves purchasing power in a way that fiat currencies sometimes cannot. Its intrinsic value does not rely on government policy or corporate performance, making it a reliable store of wealth during periods of financial instability. For example, during the 2008 financial crisis, gold prices surged as confidence in banks and paper money wavered, illustrating its role as a protective asset. The metal's appeal also extends to its global recognition. It is universally understood as valuable, liquid, and portable, which makes it an attractive option for diversifying investment portfolios and managing risk. Central banks around the world hold gold reserves as part of their strategy to maintain economic stability and build confidence in their national currencies. This institutional backing reinforces the perception that gold is a dependable asset, capable of mitigating some of the uncertainties that accompany economic downturns. Moreover, gold often acts as a hedge against inflation. When the value of paper money declines due to rising prices or expansive monetary policy, gold tends to retain its real value. Investors looking to preserve purchasing power can convert a portion of their savings into gold, ensuring that their wealth is not eroded by inflationary pressures. The metal's historical consistency gives it a psychological edge as well. People trust it during times of uncertainty because it has repeatedly held value over centuries. For a national economy, emphasizing gold reserves can provide a buffer against extreme market volatility and signal financial prudence to both domestic and international stakeholders. However, it is important to recognize that gold is not a solution to all economic problems. While it can stabilize perceptions and provide a hedge against risk, it does not create jobs, increase wages, or directly stimulate economic growth. Its value is largely defensive, offering protection rather than actively driving expansion. Additionally, the physical constraints of gold, limited supply storage requirements, and liquidity considerations mean that it cannot be rapidly mobilized to address sudden crises in the same way that monetary policy tools or fiscal interventions can. Despite these limitations, The role of gold in maintaining confidence during uncertain times remains significant. Its stability makes it a preferred asset for risk-averse investors and policymakers who want to signal financial prudence. Understanding its historical and practical significance is crucial for evaluating its potential impact as part of broader economic strategies. Gold's enduring reputation as a hedge against uncertainty ensures that it will continue to play a critical role in financial planning and investment, serving as a reliable anchor in a world where other assets may fluctuate unpredictably. Investment. Cryptocurrencies have emerged as one of the most talked about innovations in modern finance, offering an alternative to traditional assets and challenging long-standing financial systems. Digital currencies like Bitcoin, Ethereum, investment, and others are decentralized, meaning they are not controlled by any single government or institution. This independence makes them particularly attractive during times of economic uncertainty or distrust in traditional banking. Unlike fiat currencies, which can be influenced by monetary policy, interest rates, and government interventions, cryptocurrencies operate on blockchain technology, providing transparency, security, and a level of autonomy that has never existed before in financial markets. For younger investors, tech-savvy professionals, and those seeking to diversify their portfolios, crypto represents a new frontier of opportunity. Its rapid rise in popularity has been fueled by the promise of high returns, accessibility, and the ability to transact globally without intermediaries. Investors see crypto not only as a speculative asset, but also as a potential hedge against inflation and currency devaluation, similar to the role gold has traditionally played. Unlike traditional investments, cryptocurrencies can be divided into fractions, making them accessible even to those with smaller capital. Moreover, the blockchain technology underlying these digital assets provides additional utility, such as smart contracts, decentralized finance applications, and tokenization of real-world assets. These innovations could fundamentally change how people interact with money, invest, and even manage contracts and property rights in the future. However, the volatility of cryptocurrencies cannot be ignored. Prices can swing dramatically in a matter of hours or days, exposing investors to significant risk. While high volatility attracts speculative traders looking for large gains, it poses a challenge for anyone attempting to use crypto as a reliable store of value for broader economic stability. Regulatory uncertainty is another concern. Governments around the world are still figuring out how to regulate cryptocurrencies, which adds layers of unpredictability to their adoption as a mainstream financial tool. Taxation, legal recognition, and anti-fraud measures vary widely between jurisdictions, creating potential obstacles for mass adoption. Despite these challenges, cryptocurrencies have proven their ability to attract capital, stimulate technological innovation, and create new markets. They offer a level of financial inclusion, allowing people in countries with unstable banking systems to participate in global commerce and investment opportunities. For policymakers considering the role of crypto in national economic strategy, the potential is significant but requires caution. Integrating cryptocurrencies could encourage innovation, attract investment, and provide alternative financial channels, but it must be balanced against risks such as market instability, fraud, and regulatory gaps. While crypto is not a panacea for economic challenges, it represents a growing segment of the financial ecosystem that cannot be ignored. Understanding its potential, limitations, and strategic applications is essential for evaluating its impact on modern economies. Cryptocurrencies are redefining the boundaries of finance, offering opportunities for innovation, diversification, and global participation, while simultaneously introducing risks that must be carefully managed to harness their full potential for economic benefit. Relying on unconventional strategies such as gold and cryptocurrencies to stabilize a national economy comes with significant limitations that are often underestimated. While both assets have their merits as investment vehicles, using them as the primary tools for economic recovery oversimplifies the complexity of a modern financial system. A national economy is an intricate web of industries, labor markets, consumer behavior, global trade, and government policy. No single asset class, no matter how valuable or innovative, can address structural problems like unemployment, income inequality, or fiscal deficits on its own. Gold, for instance, is a safe haven that can preserve value during times of uncertainty, but it does not generate jobs, stimulate production, or increase consumer demand. Its primary function is defensive. It protects wealth rather than actively contributing to economic expansion. Similarly, cryptocurrencies offer decentralized financial options and can attract investment or innovation, yet their notorious volatility makes them unreliable as the backbone of a nation's financial strategy. A sudden market crash in crypto values could quickly negate any perceived benefits, undermining confidence rather than restoring it. Beyond the characteristics of these assets themselves, relying on them also ignores the need for coordinated fiscal and monetary policies. Stimulating growth, addressing income disparities, and maintaining employment levels require carefully designed interventions such as tax policy adjustments, infrastructure spending, interest rate management, and workforce development programs. Gold and cryptocurrencies alone cannot replace these essential components. Moreover, public perception and investor confidence play a critical role in economic stability. Introducing unconventional strategies without a clear plan may create uncertainty or skepticism among citizens, businesses, and international partners. Confidence in the economy is as important as the underlying assets themselves. Investment and missteps in communication or implementation can amplify financial instability rather than alleviate it. There is also the issue of accessibility and inclusivity. While wealthy investors or institutions can leverage gold reserves or digital assets effectively, the average citizen may not have the means or knowledge to participate in these markets. This could exacerbate existing inequalities and create a perception that economic recovery strategies favor a select few rather than benefiting society as a whole. Historical examples reinforce these limitations. Economies that have relied heavily on single assets or unconventional strategies without complementary structural reforms often face temporary boosts followed by setbacks. Sustainable growth requires a balanced approach that combines asset management with systemic improvements, such as labor market reforms, education, infrastructure investment, and regulatory oversight. In short, gold and cryptocurrencies are tools, and not solutions. They can complement broader strategies, but cannot replace the multifaceted interventions necessary to address structural economic challenges. Policymakers must recognize that the health of a national economy depends on more than perceived value or investment trends. Long-term stability and growth require integrated strategies that encompass monetary policy, fiscal responsibility, workforce development, and market regulation, with unconventional assets serving only as supportive elements within a comprehensive economic framework. The broader implications of adopting gold and cryptocurrencies as central components of economic policy extend far beyond immediate market reactions. Policy decisions that prioritize these assets can influence investor behavior, investment, affect global perceptions of financial stability, and reshape the allocation of capital within the economy. For instance, emphasizing gold reserves may signal fiscal prudence and a commitment to long-term value preservation, potentially increasing confidence among domestic and international investors. It can act as a stabilizing symbol during periods of uncertainty, reinforcing trust in the government's approach to managing financial risks. However, relying heavily on gold may also create an overemphasis on preserving wealth rather than generating economic growth. While it can protect value, it does not directly stimulate employment, innovation, or consumer spending, which are critical drivers of a healthy economy. On the cryptocurrency side, integrating digital assets into national policy has both opportunities and risks. Cryptocurrencies can attract technological innovation, promote financial inclusion, investment, and provide alternative investment avenues. Their global accessibility allows people to participate in markets that were previously out of reach, potentially fostering economic activity and entrepreneurship. Yet, their volatility presents a real risk. Rapid fluctuations in value could destabilize financial markets, erode investor confidence, and create uncertainty for both individuals and institutions. Regulatory frameworks are still evolving, and inconsistent or unclear policies could amplify these risks rather than mitigate them. Moreover, the broader societal impact of such policies must be considered. Gold and crypto strategies might disproportionately benefit those already positioned to take advantage of investment opportunities, leaving average citizens with limited ability to participate. Then, this could exacerbate existing inequalities and generate skepticism about the fairness of economic policies. Policy decisions that appear speculative or untested on a national scale may undermine confidence in government leadership, especially if the general public perceives these strategies as prioritizing asset holders over the broader population. Another key consideration is the long-term sustainability of integrating unconventional assets into economic management. While gold and cryptocurrencies can provide temporary boosts in confidence or liquidity, structural challenges such as fiscal deficits, unemployment, inflation, and trade imbalances remain. Addressing these systemic issues requires coordinated policy efforts beyond asset allocation, including targeted investments, regulatory adjustments, and social programs that support economic growth and stability. Policymakers must balance the potential benefits of these unconventional assets with the broader objectives of economic health, ensuring that interventions do not create new risks or deepen existing vulnerabilities. Understanding the interplay between market perception, investor behavior, and structural economic realities is critical. Missteps in implementation could result in heightened volatility, reduced trust in financial systems, investment, and unintended consequences that ripple across industries and demographics. Ultimately, while gold and cryptocurrencies may play supportive roles in shaping financial policy, they cannot replace comprehensive strategies designed to foster sustainable growth, equitable opportunity, and long-term economic resilience. Decisions must account for both immediate impacts and far-reaching consequences, ensuring that policies serve the economy as a whole rather than offering short-term solutions that fail to address underlying challenges.